welcome everybody. Lovely to be here again on our regular Thursday morning webinar sessions. Although last week we did have a week off, which I missed because it seems to be the only reason I shave anymore. I think it's when we have our regular webinars. So 2 weeks off, I've just been a mess. So it's good to be back. Thank you very much for joining us. Today's topic, we focused on finance. We've been doing a few verticals recently, and we have a couple more coming up soon to look out for, which we'll tell you a little bit more about towards the end. So today I'm delighted to be joined by an excellent group, a representative group across the industry to talk you through all things in this critical vertical in terms of what's happening currently and hopefully some best practices and recommendations for the future. We have Emily Smith from OMD. Sebastian Graham joining us again from Verizon Media. He's been on a webinar a few months ago and focused on native. Delighted to have Nat, our research director, joining us. She'll be opening with some insights and trends that we've seen recently. And then we have Milan from Crimtan joining us, who's the country director there. They have a number of financial clients they work closely with. So the format will be that Nat will open to provide some general insights. Then we'll have Sebastian with some more pointy trends that Verizon have been seeing through their platform with some really key call outs. And then we'll move to the panel. Everyone, please feel free to input questions into the Q&A tool there, and we'll incorporate them either through the panel questions or certainly towards the end, we'll take the time out to answer those questions. And if there are any questions that we can't answer, or if we get inundated, we've done this before, we'll do a follow-up article where we can take on those key topics. But for now, just to get us going, I'll hand over to Nat, who's our research director over at IB Australia, to kick off with some top-level trends and consumer insights. Please take it away, Nat.
There we go. That look okay?
That's
thanks, great. JJ, and thanks for everyone joining us this morning. I'm going to kick off today's session with a short overview of the online finance landscape. The data here predominantly sourced from our digital measurement currency Nielsen. So Australians have for some time embraced online finance. The fintech and financial institutions continue to innovate in this space and offer Australians new and convenient ways to send and receive money, to shop, to make payments, and generally manage their finances all online, often enabled by mobile technology. So we've got around 17.6 million. So most Australians use online financial content tools and services at some stage during a month. And you can see there that most people visit their banking website or app during a month. And most people are using financial tools. So by far the biggest financial tool in there is PayPal. But there are lots of other options emerging, the buy now, pay later and other online payment options, as well as some of the accounting software tools. And we've got 8.4 million Australians reading financial news and content, provided generally by our domestic and overseas news publishers. We've got Australians using the global specialists, things like Forbes and Wall Street Journal. And 4.8 million people visiting online trading sites on apps each month. So CommSec there being one of the most widely used tools, but it also includes Australians using micro investing app like Acorn, and the Bitcoin sites are also included in that number. And you can see there are also some significant numbers using insurance, credit cards and loan sites each month. So of course, COVID is having a major impact this year. Australians have been seeking to understand the implications of COVID on the economy, as well as businesses and their own personal finance. In March this year, in that first month of lockdown, you can see there that time spent in the category of online finance jumped up 29% on the previous month, which was a 13% increase in time spent year on year. So that activity has normalised since then, but over this calendar year, so from January to August this year, time spent on online trading, on financial news and insurance sites in particular have significantly increased. So looking at some of those specific areas of online finance that have increased consumer time this year, you can see online trading there, overall increased 18% year on year. And there are some examples there of some very large increases in specific sites and apps. The ComSec site there being one of the biggest, up 124% in total time spent. Not all of the Bitcoin sites are up, but one in particular they're also increasing, as well as the ASX site. It's probably not surprising that we've got a large increase in people looking at health insurance this year. So that the health part of insurance drove an overall increase of 27%. And you can see those big health insurance brands there increasing quite significantly this year. Also, the majority of financial news and information sites have increased this year. So it was hard to find a site that didn't increase in this area. So overall time spent increasing 26%, around the content of business and finance. While the overall time on financial tools hadn't increased significantly year on year overall, there were some examples of tools, things like the ATO app up significantly, TransferWise, people transferring money around, and also PayPal up. There's also a significant number of people getting on board with the buy now, pay later segment of financial tools. So the audiences there, some of those audiences growing quite aggressively. So you can see Afterpay this year, the number of people using that service up 27%. So many of the new and convenient ways to manage finance is often enabled by mobile technology. In August this year, nearly half of all time spent in the finance category was on smartphone, opposed to PC, laptop and tablet. You can see there that mobile banking in particular drives that overall time on smartphone for the category, while other areas of finance like tools and online trading, there's definitely a preference still to consume that content and use those tools on a PC or laptop, the bigger screens. So Australians engaging in online finance, the time is fairly representative across age and gender. So there is 48% of total time in this area is spent by people aged 45 plus. There's a slight skew to older audiences for engagement in financial news and information. And there's a slight skew to younger audiences, so the under 45s, for engagement in those financial tools and online trading. So lastly here, a look at the investment in online advertising. Investment in online advertising by financial insurance advertisers has grown steadily over the last 2 years. In the last financial year, that investment has grown 20%. In particular, you can see there that last quarter of the financial year, so April to June of FY20, we've got a strong lift in investment. That quarter is up 30% year on year. So great to see that advertisers, have continued their investment through the COVID period, which will, make them come out the other side of this current economic downturn in great shape. So good to see that continued investment. That's all from me for now. I'm going to let Sebastian take over now. I'll just wait 1 second while he does a quick swap over there. Very seamless. Thank you.
Thank you very much. Really interesting details and insight. And hold tight while I try and get my computer to work and to share and to make everything execute the way it should. Fantastic. What a significant year this has been. I'm pretty sure we all know why, and I'm not going to waste your time by using things like unprecedented and new normals and all those sorts of things. Instead, I'm going to spend a bit of time drilling into data from Verizon Media and what we're seeing in a consumer lens from finance. We're going to tap into that in conjunction with some third-party data, some more reliable sources, and perhaps some things if you work in an agency you may not have seen, and if you're in a client-side role, you're probably aware of just as much. But most importantly, I'm going to try and give an insight and a lens on that from what the implications are for marketers and how that works and delivers and executes. Oh, how do I make this work? There we go. The very first thing I'm going to do is to emphasize the Consumer Confidence Index. So for anyone who's not aware, consumer confidence is essentially a question of how well off do you think you're going to be in 12 months' time. This is the monthly data over the last year or so, coming through from the Westpac survey. And in grey are the normal months. They're pretty much as you're seeing across the board. And being an index, consumer confidence is scaled from 0 to 100. Our best month in this entire period is at 93. So in general, across this last year or so, Australians are not very confident around what their financial position is going to be in a couple of years' time. However, there are two really key lockdown periods which have dragged that back significantly, both April and August, where it's down into the 70s. I've included two benchmarks here. One is for the GFC in 2008. And this is around about where we are now. The absolute bottom, the lowest level of confidence we saw in the GFC is where we are around about since Q2 and Q3 of this year. I've also included 1990 because this is the only time that we've seen a lower level of confidence than we're seeing in our lockdown periods. 1990 is 30 years ago. The Australian economy has been on a really great run. And personally, I'm a little young, so I don't actually remember 1990. I had to ask my mum what it really meant for finance. And she came back to me with a 20-minute long rant, which I won't repeat now. The 17% interest rates were a big part of that conversation. So we're in a world where people are as low in confidence as they have been for 30 years. This is really impacting on consumer spending and on consumer behavior. And you can see this with consumer behavior. Nat shared some beautiful details on what people are doing with personal finance and the increased level of interest. I don't have access to all of that data, so I've instead asked our editor-in-chief for Yahoo Finance, Sarah O'Carroll, who's shared some data with us that we're up around 220% year to date in total audience coming through to Yahoo Finance. And her explanation from this, aside from the incredible work that her and her team are doing, is the amount of change and impact on the Australian life. In reality, we're seeing three massive drivers. 1 million people are now jobless or effectively jobless and supported only by government subsidies. We've got 1 million businesses which are relying on government assistance to stay afloat. Think about this. There are 2.4 million businesses in Australia. Almost half of them are taking on government assistance. And the volatility in the stock market, as you've seen with Nat's data, we're seeing huge changes and huge amounts of demand for stock as well. Trading accounts have tripled nearly in the last year. So a huge change in really significant impacts on personal finance, all of which is caused by individual financial situation. A lot of people have been personally and materially impacted, which is impacting heavily on their behaviors and their attitudes around finance. I wanted to look at quickly the entire economy of Australia as well. And there's 5 big headline stats here, but I'm really only going to drill into 2. $1.1 trillion is the consumer spending in Australia on last year. This is data from APRA, and amazingly and thankfully, Australia has some really good recording of our data. The GDP is a little bit higher than that at 1.9. The share market is 2.2, and compulsory super we've built up since the, I believe, late 80s, 2.9 trillion. And then residential real estate is the massive, massive component of our economy, almost as big as everything else combined at 6.6 trillion. It is a huge driver. Real estate makes up a massive part of our economy. In finance terms, real estate translates through in home loans. So what we're going to do, and I'm going to cut this a little shorter than the full version, is I'm just going to drill into consumer spending and into real estate, and the impacts of this year, this really significant year, on both of those. So let's kick off with consumer spending as it relates to finance. So very first thing is discretionary spending. This is data from Ilion Credit Bureau and Alpha Beta Partners, who have got a wonderful live tracker. They break this down by category as well, but I wanted to do the simple version. Discretionary spending is reasonable, to be honest. It's about flat. There is a clear negative period through the first lockdown, and there's also a clear negative period where Victoria, which makes up about 30% of the population, is also in lockdown. Other than that, we're actually spending pretty well right now. You can see the super withdrawal, particularly the second one, created a burst in spending, and actually the categories that spent in are a little concerning if you think about it from a holistic perspective, where that went into gambling and food, a little concerning. But this is the world of finances we live in. But overall, consumer spending is not massively impacted, which means a lot of what we're seeing right now, we've gone into a technical and an official recession. Right now, that's a business recession. Businesses aren't spending. Consumers are still going just fine. There are some changes to that makeup. Cafes, restaurants, pubs are down, travel is down, and online food ordering and gambling are up. But overall, the amount of discretionary spending that consumers have is still fine. That might change in the future, and when we get into the very end, I'm going to make a comment around that. When we look at from a finance perspective, consumer spending, what we're really looking at is how much credit application has changed. This is a view again from Ilion Credit Bureau and Alpha Beta Partners, and unfortunately the data that I got couldn't carry through this last 3 months, but we saw about a 30% drop at the beginning of lockdown, which carried through to the end of financial year at about a 25% drop. And this touches on all credit volumes. All credit products are impacted. Personal loans, credit cards, anything that is a driver of credit application has changed. This has obviously caused disruption and impact for all of the finance marketers and all of the finance category, because there is much less value coming in. This is the biggest driver of marketing and of activity for financial services. If we look at the response from financial service marketers, however, as Nat mentioned in her data, they are spending a lot more money. So there's this 3 big prongs happening in the world of consumer spending. Consumer confidence is down, marketing spending is up, and the results from that spending are not there in the short term. We're not seeing a big increase in acquisition or credit application. So there's really interesting questions on what marketers are actually doing with that investment and in that spend, because they're not driving conversions and not driving applications the same volume as they used to. Some really wonderful brand building, I think, is happening right now. Oops, sorry, double press there. When we go in and we tap into the Verizon media data, where we can extract and understand data from a more granular level, we can actually look at the products that people are buying and using and understanding in there. And I've taken the point of view here to try and understand and interpret the mindset and the focus on users from a financial product perspective. The very first we're seeing on the left, as Nat alluded to, we've got a significant increase in cash and cash replacement products. These are things like payday loans, they're afterpay, they're buy now, pay later products, which are just trying to push out that spend line and push out when they actually need to pay for things. This is a huge increase, plus 26% year to date, which is a massive, massive growth. The other piece we're seeing really significant growth is in a much longer time. We've already mentioned home loans being $6.6 trillion in the real estate market, and about a third of that containing a home loan. We've seen shares which have tripled in this last year, and a lot more investment activity, some of it in low risk, things like term deposits. What we're seeing and what this means from a consumer mindset is that some consumers, most likely that million who have been personally and financially impacted by this year have focused into survival, into really last minute, short-term focus. How can I pay the bills I need to pay now? And come what may in the future, I'm going to pay later on all of those. Whereas the people who haven't been as impacted, if you've managed to retain your job, not have to take a pay cut, not have shorter timeframes, your actual opportunities to spend in consumer spending have gone down significantly. We're definitely not spending as much in restaurants and cafes. And if you don't gamble, your other option of where you're spending your money is in investments. We're seeing that with significant growth in home loans, in shares and term deposits and the like. And this is really why I've decided to call out home loans as the second category that I was going to focus in on, because home loans have changed drastically. Before I do that though, I do want to tap into some Nielsen data where we've pulled apart a secure and an insecure position from the financial positions of users. Insecure being people without a lot of income and without a lot of savings, and secure being people with high incomes and high savings. And we're looking at a couple of really important financial indicators here. You can see it on the board, but most people who are in a secure position have a lot more investment and they're not in a position where they don't have spare cash. Insecure positions are complete flip. More importantly, when we look at the questions on whether or not they're feeling secure, there has been a significant change in the March-April review versus December-January review. In March and April, people who are in that secure position are feeling even more secure in just a few months' term. They've had confidence given to them from their financial position and from their work position, most likely. The other way around, people who are less secure are far less secure than they were earlier in the year as well. So you've got this big dichotomy of what's happening in the economy. I don't want to say two-speed economy, but perhaps that's something that we need to consider in the next year as something that is going to really impact on us and on our consumers. So $6.5 trillion, 2.1 trillion of home loans. What is happening in the biggest sector of our economy and the biggest sector of our financial services market? So very first, we are seeing growth still in the volume of home loans. So it's really interesting when we look at this. If you look for the last 6 years, there has been a consistent decrease in the rate of increase. So it's still growing, it's just not growing as fast as it was. That's not unexpected because we've seen that every year since about 2015. So this is a consistency within the market. We're not seeing huge changes in there. And I apologize, I haven't actually written the source on this slide. It's APRA as well. So this is really reliable data in there. It's growing at about 3.5%. And even in the months of June and Q2, it's growing at 2.5%. So there are still more home loans being taken out and more value of home loans existing than there were a year ago or 2 years before that, and so on and so forth. So the opportunities for people to save and to retract and to confine within this market haven't been taken. This higher, longer term mindset, higher income, more secure environment are still investing into home loans at about the same trend as we have seen in the last few years. But when we look at demand signals, and this is from Verizon media data, a combination of applications that we've seen as well as search data across the Yahoo search environment, we've seen significant growth. There is almost 100% growth in the amount of interest and inquiry in home loans across Q2 and Q3 as there was in Q4 and Q1. So there is a lot more interest in home loans happening, which reflects exactly what Sarah O'Carroll, our editor-in-chief for Yahoo Finance, was saying around her market. And it reflects exactly what we're seeing from a demand and from a consumer mindset perspective. People are spending a lot more time within these markets and they're actively growing and developing more. The big winner, however, is the big four banks. If you look at the home loan market, and again, APRA data here, somewhere near $1.4 trillion of the outstanding mortgages in Australia are held by the big four banks. That's around about 78%, up from about 75% just a couple of years ago. So that share of market by any other bank is 0.4 trillion. So there is a real power and strength and growth of these brands within there. When we go through and you look at the rates and at the product in here, there is not a significant discrepancy. The major driver of these four banks taking this share and owning this share is the brand and the trust that they've built up. Which raises some interesting questions for marketers in the long term of what they need to do. But I think in the short term, there are three major takeouts the marketers need to consider. The first, brands are growing. The people that are trusted are growing, especially in the economy that we've got right now. The second right now is the change in consumer mindset and in consumer spending. Who's looking at a long-term trend and who's looking at a short-term trend? How do you identify which of your products are best suited to each of these markets? And how do you build the confidence and build the brand to that product, to that market? And the last piece is on October 6th. Josh Frydenberg is going to hand down probably the most significant budget that we have seen in our lifetimes. There are three major things that we need to keep an eye out as finance marketers. The first, job seeker and job keeper. What is going to happen to that? There's 1 million people and 1 million businesses which are supported by those two right now. There is a real need to change and to focus and to really understand what's going to happen there. The second is jobs. There's 1 million unemployed people in Australia, or 1 million people who would be unemployed if not for if not for job seeker and job keeper. It's crucial that we understand and respond to the policies and the changes that the government are going to make to impact on jobs. And the third is business support. I mentioned it earlier, we are in a recession. That recession is right now a business recession. Consumers aren't feeling it. The discretionary spending is still just as high in aggregate. Yes, individual consumers will be feeling it, but right now this recession is a business recession. What's going to happen to change that on October 6th? This is probably the most important 2 hours of TV you could watch, is to watch that and to read and to understand exactly those three categories and what's going to happen. And with that, I'm going to hand back to Jonas to lead us in for a Q&A. Thank you very, very much.
Thank you very much. Whoops, great stuff, Sebastian, as ever. Trying to find out where on earth right, just to bring everyone else into the panel session now, please. I seem to be promoting next week's webinar for some reason, a bit early. Thank you very much. And it's great to have all of you here as a representative group. And in fact, we're going to jump in with you first, Sebastian, on the back of that presentation. That's the slide there on the home loan applications being quite skewed towards the big four and a bit of consolidation. What recommendations do you therefore have for the other brands looking to challenge these established big four banks over the coming months?
Yeah, I think it's going to be really challenging in the coming months. I might refer back to kind of this idea and this concept of investing. The best time to start was 20 years ago. The next best time is now. So in the long term, every major brand, every brand that needs to exist and to compete will need to run through a proper segmentation, targeting, and positioning program. You'll need to understand the market and understand your customer and build the brand into that. That's not going to change your world in the next couple of months. In the next couple of months, you probably need to start on that, understand who your program is if you don't have one, and who your customer is. But in the short term, it's very much an understanding of who your potential customer is right now, and understanding the distinctive questions, the pieces around why they would choose you, and make sure you're emphasizing and delivering that. One caveat that I do want to make, however, is I don't think right now a cheap rate is enough. We've seen in previous years significant changes in conversion rate when you have a better home loan rate or a better term deposit rate than other brands, and significant changes in the application volume and in the conversion activity you get. We're not seeing that right now. I think the rates are so low across the board. The distinguishing factor and the differentiation just isn't as much as if you go back a few years when rates were in the 4s and 5%. Now it's 2.5%. It can't get much cheaper than that anyway. So your distinctive element, your assets and everything that makes them choose you needs to be built out of something other than rate. I genuinely believe that right now.
Great stuff. And from your perspective then, Emily, as you have a number some key financial insurance clients, how are you consulting proactively with your clients during 2020 and this ongoing pandemic?
Yeah, so I think the last year, even prior to the pandemic, has clearly been quite a turbulent time for both insurance and banking clients with the likes of the bushfires, etc. I think what's been great at OMD is that we genuinely see our clients as long-term business partners, kind of touching on what Sebastian said. And for Suncorp, it's no different. So we've had a really collaborative, transparent working relationship when it comes to addressing those challenges. For COVID specifically, we had a number of different OMD proactives and initiatives which went out off the back of COVID. So including a brand by brand bespoke response, which looked at the initial outbreak, the peak, the recovery, the post-recovery period, and provided a perspective on impact, but also recommendations. We also introduced a concept called ideas in isolation, which was built out based on individual client challenges and presented proactive ideas that could actually be activated within COVID. So for Suncorp, that was a really great integration. I don't know if anyone saw it, but with the Today Show, and it was talking to sharing the spirit and nominating, audiences could nominate their Aussie hero that needed a boost. More broadly, we provided investment updates such as changes to programming, thought leadership around events such as Cannes, given that no one could actually travel there, client live streams, weekly consumer sentiment reports, and we also lent on our platform and publisher partners just to make sure that we actually had that real-time insight on category and consumer trends. I think from a Suncorp perspective, we've always had forums and process in place to ensure collaboration, but what was really great, I guess, if you can see a silver lining off the back of the pandemic, is that expedited any conversations around improving the value that we extracted from those forums so that we could be agile in any decisions we were making. So really making it cross-functional, any conversations that we were having. And I think Sebastian touched on this in his presentation, but a key focus for us was securing a balance between the short-term response measures, such as reallocation of investment in line with consumer behaviour, and that longer-term business vision. Because as you'd be aware, a lot of brands have to be a lot more reactive when it's harder to hit those short-term objectives. So I think what's been great is over the last 18 months, we're kind of ahead of the game because we've been working really closely with Suncorp to collectively build out a framework that supports that longer-term business vision. And so there is that focus on longer-term growth as well as ensuring we hit the shorter-term objectives. I think what's also fortunate from our perspective is that Suncorp's leadership is very much aligned to that longer-term view of investment in brand and marketing being a growth driver. Many of you may have seen the coverage around Mim Haysom, who's the CMO at Suncorp, and Mark Ritzen's podcast that actually talks to no COVID cuts and upweighting brand, which obviously from our perspective made conversations a lot easier.
Mm-hmm. Great stuff, thank you.
If I might, I really liked the approach that OMD took. I observed a little bit of that from our side. One of the things that I found really impressive was the emphasis on understanding there is a lower conversion demand right now and a hugely increased amount of interest. So we touched on some of the behavior signals from both from Nat and from myself. And for brands that weren't as focused on understanding and properly developing a growth and a brand approach, there was easy to get lost in this huge amount of signal and interest. And, it's increased audiences, increased search volume, increased interest, increased everything, but actually not coming through to convert as well. I think a lot of what Emily was talking about from Suncorp is really almost best practice and best it could have been.
Yeah, and I think it's about extracting digestible insight and finding the insight that matters, because yeah, like you say, there's so many different data points, so many different trends. How do you consolidate that and actually pick out the important nuggets that you can then apply?
Yeah, that's a good segue actually into what you're doing at Crimtan, Milan, because the collateral from this session and the recording, by the way, will be made available, will be early next week, certainly to all of you attending this webinar. And along with that, we're going to share some research that Crimtan have done recently. And in terms of actionable signals and consumer insights within that research, you've got a sort of new genre of customer type that you've been pulling together for your clients as you've seen emerging recently. Can you tell us a little bit more about these users and any related recommendations?
Sure, thank you, Jonas. So for those of you who aren't aware, so we're an independent programmatic expert that utilizes customer lifecycle strategies delivered through dynamic creative. What we've seen over the last 12 months, maybe 12 to 16 months, has an emergence within the finance sector of a new type of customer. We're really fascinated in terms of the new engagement points that we're interacting with these users, with the various financial brands that we're working with, and how they're responding accordingly. We've break that down into 5 key areas. First is the more privacy-focused customer. Now, what do we mean by that? So a lot of us on this webinar are probably aware of the new privacy changes going on globally and within Australia, whether it be the CDR, so the customer or consumer data right. We've seen the changes with Alphabet and Apple with their wars with IDFA, the restrictions of third-party cookies. So, we're not seeing a real single source of truth anymore relying on third-party cookies, which is shaking up a lot of aspects. Additionally, with these new regulations coming forward, it's probably the best brand uplift survey our industry's ever seen, because we're seeing a lot of customers and consumers, I should say, putting their hand up and saying, the way I'm being advertised to, the way that my data is being utilized isn't in my best interest. So I'm going to opt out, or I'm going to sign out, or I'm going to object. So brands that we work with are becoming much more conscious across global markets with how they communicate with relevant messaging. And we think that's really important in terms of overarching strategies moving forward. Further to that, the second point is the new consumer sentiment. What we mean by that is how these new customers' values should be aligning to the core principles of what these finance brands stand for. So a lot of behavioral shifts and changes that we've seen have been coming not just from global influences, but also local ones. So look, we're all aware of the Royal Commission that occurred very recently. We're also aware of, let's be honest and call it for what it is, some of the recent scandals that have some of the bigger financial institutions have been involved with. So it's really important more than ever for brands to really differentiate themselves in terms of the strong value sets that they have, the initiatives that they execute, and find unique data sets and align relevant creative and messaging and strategies to those consumers to bring them back into their engagement pool. Because things that we're finding now, and it's not just aligned to finance, actually, you can align that to retail as well, but really strongly with finance is consumers are finding more brand loyalty to brands that align more closely with their own preferences and principles. And those that do align really well are seeing more of a long-term increase in terms of their engagement and also connecting and advocating that brand. So we're seeing that a lot with things like environmental factors. So if you look at the Australian Institute's recent data in terms of climate change, just as a single point, we're talking a lot about COVID now, but in January, Australia was on fire. We forget about these big impacts in terms of values that Australians really care about. So right now, over 50% of Australians believe that the federal government's not doing enough in terms of advocating change, positive change with climate change. So what does that mean for brands? There is an overwhelming percentage of Australians that also feel that brands are responsible in terms of pushing this initiative. So we work with Bank Australia through a partnership with Alchemy One, and they're doing a fantastic strategy in terms of advocating this positive value shift in terms of reaching out to a potential new customer base and bringing them in based off these values. And I only implore anyone on this webinar to have a quick search in terms of users, or I should say customers, now looking for new alternatives to the big banks. Now, in the leave behind that Jonas will share, some of the recent forum posts on Reddit or any other user-based engagement forum, we'll see a lot of people asking and looking for alternatives because they're just over the the stigmatized view of big financial institutions. So it's really important for brands to focus on that. The other three I'll probably talk about a little bit later, but are really important to mention here is how COVID's really impacted the change in consumers' behavior. Sebastian and Emily mentioned some really, really strong points, along with Natalie as well, with what those changes actually are and how you should be also, from a four-point, aligning your relevant marketing strategies to engage with those users. Like, we should be moving towards more sustainable digital strategies and moving away from just traditional kind of spray and pray. Like, we've all seen the old advertising of, a young couple moving to a new home carrying big boxes. I don't think that's effective anymore. I think we really need to go down to the core values. And I think the brands that are doing that in the financial sector are engaging really well, are seeing huge performance increases on that. Thank you, Jonas.
Good stuff. Thank you. And Nat, thank you for your prezzo and your insights earlier. Now, something else we worked on earlier this year is a big project which you led, which in fact sort of Milan's final point there's a key part of is a report called The Advertising Through Economic Downturn, the reasons to keep spending through a recession. Could you tell us a little bit more about that study and some of the key insights?
Absolutely, yeah. So you can actually download the report from the IAB website. It was actually a synthesis of a number of research studies that have been conducted over the years into advertising and marketing through economic downturn. And the general body of wisdom from these market research studies was that continued investment in advertising during a recession can make a company and its brand stronger. And the opposite, that those who don't can actually face detrimental impacts down the track. So often, we know the immediate response in tough times is to cut costs and focus on what brings in, immediate revenue. But this body of research does say across the years that this can have, a negative effect on the longer term, including things like not regaining sales and profit from pre-downturn levels, to loss of market share and loss of brand salience. So, we know stronger brands help businesses survive turbulent times. So those brands with stronger brand equity recover faster. So, continue the ad investment to put you in good shape when this is all over.
Yeah. I think, Emily, you're in a really lucky scenario where Suncorp is actually actively and comfortably taking that position. Are you able to share anything with how they're feeling internally and how satisfied and happy they are with that approach?
Yeah, I think, like I said, I think it's great because I think the leadership really do believe in brand building and how important that is to maintaining the brand presence for the longer term game. And I think they're very much strategic marketers in terms of their longer term vision. So completely appreciate that there's that need for the short term target to be hit, but equally, I think feel very lucky to be on a brand that is kind of future facing and actually thinking about the longevity.
And we'll include a link or even the copy of that report in the Leave Behind event page. By the way, it's someone's just sent a question through on that. Don't worry, along with all the other related collateral. So look, maybe just pivoting a little bit towards product and messaging topics. Sebastian, what have you seen from a product perspective that's working particularly well for your financial campaigns right now?
I'm obviously heavily biased towards native, as I should be. But we're seeing really it's less of the more traditional channels that are working as well as we'd expect. So we mentioned search and the interest and the demand for search has really increased. My understanding from our partners and from our marketers who work in the search world from a financial services perspective is they're not seeing a direct response return from that they'd normally expect. So we're seeing a lot of emphasis and move out of search and into more traditional channels from an effectiveness perspective. So things like CTV and the activity and the ability to drive that big full screen interactive element, particularly with a proper audience overlay on the top of it to make sure you're still driving that segment perspective has been really important. The other thing we're seeing quite a lot of is a lot of educational marketing working very well. Where finance is unquestionably a complicated category. Part of the reason that we're seeing so much change in audience interest and behavior and the amount of signal that's out in market is because people don't feel they know enough. So a lot of the more successful campaigns have been educating people and some really interesting differentiations between what big brands are educating on versus what you'd almost call them growing or hope to be growing brands are educating on. The big brands, they don't need to educate who they are. So their education has been much more focused on segment activity. So here's a segment of business owners, and here's the education to the business owners about what we're doing for you and how that works. And here's a segment of people who use our banking apps. So here's the education for what you can extra do within that app and how we can service you more in this time, and much more in a service and customer experience element. Whereas kind of the tier 2 brands or the brands that don't have that established brand equity are either explaining here's who we are and trying to build that education element there. So using the bigger impactful channels to send a message of we are this is what we do and this is how we do, and starting that brand building journey there. Or in the more complicated categories, which have a lot of latent demand, things like share trading, which is growing quite significantly right now. Education on what and how to share trade. Some of it coming from a lens of what to do in this time, and some of it coming from a lens of what's working well and what's not working well. So a big emphasis on brand building and on education is working really, really well. And for the brands who engage in that, we're seeing better direct response results from their campaigns as well, as compared to a player or a marketer who only focuses on direct response. They wouldn't have as much equity, they wouldn't have as much performance, and they definitely see a bigger drop than what we're seeing from the Ilion data in terms of applications overall.
And Emily, you mentioned some great examples of creativity and collaborating with customers such as Suncorp that you have, but how about sort of messaging? It's something that came up recently in a travel webinar that we held a few weeks ago. They're just getting that balance right in terms of messaging that remains impactful, but you still have to be a little bit softer and perhaps a bit more empathetic currently. Any tips and recommendations on that?
Yeah, so I think from my perspective, it's really important for a brand to be authentic. I think this becomes increasingly important during a time of crisis because it actually gives a brand an opportunity to tangibly demonstrate their brand values. So walk the talk, so to speak. And I think messaging and brand behavior should reflect that. From a Suncorp perspective, and when I say Suncorp, not just Suncorp, but Amy, Apia, GIO, the whole suite of brands, I think they inherently prioritize supporting customers when it matters. And that's demonstrated by their on-the-ground support in times of crisis. But equally, within COVID, they instigated a number of new initiatives. So some included free roadside assist for healthcare workers. They made special arrangements or options available, including hiring car flexibility, local supply options for property claims. And some of the brands such as Apia actually formed partnerships with 5 Good Friends, as an example, which really looks at reinventing how people access care services, which supports that older demographic, which were obviously quite heavily hit within COVID. So I think over and above authenticity as well, there's definitely that need to be cognizant of the environment and customer sentiment to avoid completely missing the mark and maintain that relevance. And customers really are looking for empathy and for brands to actually understand their current situation and provide that reassurance. And I think brands that can do that and really help consumers and customers navigate the longer term are really going to stand out in the future and the kind of longer term. I think effective brands, in my experience, appeal to consumer, emotional and rational needs. And I think that talks to kind of that shift towards personalization. Customers really expect brands to understand them specifically, and for advertising to actually be seen as helpful, informative and reassuring based on their individual circumstance. And I think in order to be impactful, that comes hand in hand with relevance. So if you can actually understand your customers and what they want and need, you're more likely to drive those business outcomes. In order to stay relevant, I'd say that we kind of touched on it before, but real-time digestible insight is essential. So leaning on your partners and the tools available to actually understand market, consumer and category trends as it relates to your customer groups. I think at OMD, we're really lucky to have access to a number of different tools, but we also worked really closely with Suncorp and our partners to build out and aggregate real-time data sets with kind of longer term trends to actually extract tangible, accurate insights. Because I think, we spoke to paralysis of insight overload, so making sure that you don't have that. Another thing that we looked at specifically due to the nature of the crisis was the impact in different states, but then broken down by different customer groups. So Sebastian touched on the fact that there's obviously secure versus insecure customer profiles, but however you split and segment it from your brand's perspective, really understanding that because the detail really matters in terms of your messaging and how you apply it. So whether that be excluding customers because a message is deemed insensitive, or pushing out a message that's actually increasingly relevant because you understand their personal circumstance. Robust measurement goes hand in hand with actually that understanding. So how do you make sure that you can see how your current messaging and product proof points are resonating against different customer sets? And I guess the measurement trifecta, so using platform metrics alongside MMM, but brand tracking as well. And I think it's really just making sure that whatever insight you pull out is the useful nuggets and it's digestible so that you can actually inform something off the back of it. So to summarize, be authentic, be relevant based on your customer understanding, and secure actionable insight, I would say.
Thank you very much. Yeah, you see you got some nods from the measurement expert Nat there. Just delighted with that. And actually, going to Sebastian, you brought up some of the discretionary spend trends that you were seeing. And Milan, in your report, you dive a bit deeper into the areas that you're seeing around discretionary spend. Can you talk us through that a little bit in terms of what you've been seeing recently?
Sure. What we call the COVID effect that Sebastian and Emily's probably seen as well, working with their variants of clients, has aligned well with the points that we talked about earlier around value. So we've seen an increase in number with the brands that we work with, increase in number of customers engaging with gaming chance. So firstly, you're probably thinking about buying extra lotto tickets, having a bit more sneaky bets over the weekend. Now, the first reaction to that might be people are at home, so therefore, they're a little bit bored, so they've got more time to do these things. But what we're actually finding in terms of the signals that we've been identifying, it's more that Australians and other global customer types across different markets are looking to win their financial security. Now, why does that matter for financial brands here? Because it creates an opportunity for brands to actually start engaging with these users where products align to help them secure their financial future. So whether it be linking into money saving plans or better saving rates for long term, as Sebastian was saying, educating them on things like share trading, what that looks like and how that's more of a secure return than any of these other aspects. And that's a really important indication to first think of, because a lot of Australians right now are quite concerned with their financial security moving forward. Further to that, we've seen a huge increase in terms of donations that we work with, a multitude of charity brands as well. So firstly, Australians by average are quite a charitable populace, which is fantastic, but we've seen it spike almost 200% in the last 6 to 8 months. Now, what an opportunity again in terms of values is, if there are things where brands, whether it be Commonwealth banks, work with utilizing education around customers thinking about reinvesting in communities where you can help develop new and key communities, whether it be Bank Australia in terms of their environmental initiatives. These are things that brands should be advocating in more aggressive messaging across their relevant audience targeting, because it's aligning to the more charitable aspect where Australians want to give back in terms of those who have the opportunity. Also, what we're seeing, as probably no surprise in terms of, again, it's relying on, it aligns with Sebastian's data, is how consumers are spending more time on online stores, obviously for various reasons, but then also how does previous footfall strategies have to now shift to be more on-site focus. And that's a really big thing, because consumers aren't just transitioning what they buy or engage or research from a physical sense when they go into stores or branches. They're also looking at different options around what are different avenues for them to engage in terms of the products and services. They've got more information to engage with. So it's more important than ever if a user's signaling they're interested in a home loan, they're signaling that they're interested in a personal loan or a new card, that these brands start engaging with those users earlier on and start advocating these subsets of values to align really well with them. So we're really starting to see that brands that we're working with that do focus on relevant creative and relevant strategies across these values, as Emily was saying as well, align really well and increase overall performance and leads for those brands.
Mm-hmm. There's a nice mixture of sort of core value stuff in there, but also rather concerning. Everyone just seems to be at home gambling and drinking and online shopping, which is sort of the other side of it. There's one question that's come through for you, Milan, actually, in terms of data types and sets. Is that a mixture of both first and third party, or do you have a preference over the types of data that you're utilizing for these campaigns?
Good question. So my 10 plus years now, oh my gosh, few great hairs on my beard now. Look, I don't really believe fully in third-party data. Now, what do I mean by that? So we all remember the old school days of buying segments, where it'd be, my secret source data that's, exclusive Amex data that no one else has. In the past, you can't really, who's the DMP? How old is that data segment? What is it made up of? What are the signals? There's a lot of trust. And I think Emily's point around transparency and working closely with our partners as an independent technology, we're trying to advocate utilizing first-party data more intelligently. So a lot of these signals and data sets are coming from the brands that we work with. So we don't move or utilize one data set for another brand, but what we do is try to understand all the brands that we work with and start building up patterns and understanding, from a strategic standpoint, what we can see. Is it a singular view of a single brand, or is this a trend across entire sector? And then with the first party data within our own DMP, this is what we do, is that we start creating sub-segments from data layers and then link that back to their CRM. So it's really important for brands to really start connecting those dots, because with the restrictions with things like third-party cookies, it's going to be harder than ever to actually attribute correctly or understand or prove your data sets. So
yeah, it's a cool recommendation moving forward in these current times.
Brands on the call should probably really be focusing on, talking to agencies about, what's my data made up of? If you're using my first party data, how are you using it? Where is it being utilized? And what relevant creative message is being associated to those segments? Because again, it's that old adage of, right message at the right time. I think that's more important than ever, because we're sick of seeing, the same message following us constantly. That's irrelevant.
Yeah, I completely agree on the importance of understanding the data makeup, where it comes from, and what are the exact signals that make that up. There are third-party data sources which do share that level of transparency and the validity of that data, in which case, completely fine to use third-party data. But black box third-party data should never be trusted. It should never be utilized. One of the things that marketers really need to challenge and to understand with data is what first-party data means and really what the implications of it are. The reality of most brands, and it's not true for every brand, but for most brands, is most media companies reach and understand a far greater number of audience than the brand does. So there's a real importance in understanding that first-party data from the brand itself isn't always enough to scale effectively. We need to be careful with your selection of media partner and make sure you're asking those questions of where is this data made up of? Where does it come from? How transparent is it? And how valid and reliable? Is this modeled or is it deterministic? Like, is this actually declared age and gender from several million people? Or is this actually, hey, they've been to this site, so therefore we think they're probably women, or we think they're probably 35. That's a really important piece. And I can't emphasize enough how crucial that is for marketers. The other piece that really matters with the world of data is things like GDPR, Latin GDPR, the California Consumer Privacy Act. Something is going to happen in this space in Australia as well. And many of these actually put the requirement on the marketer themselves to be compliant. It's the marketer who can be penalized. So there's a real requirement to understand the data that you're coming from, and not just the makeup of it, but what's the consent? How is that consent passed? And how do you make sure you're not going to get yourself sued and your company penalized for millions and millions of dollars?
Look, we've blown out on time, and thank you, Sebastian, on that. 2 points from the OIB's perspective. We are looking this quarter to see the launch of the data label transparency project Verizon are involved in at a global level, and the database coming out, which will be where you have a standardized kind of ingredients label for audience data segments. So that standardization will be a big push moving forwards. And on the privacy, governance, and identity, we're looking to have a couple of sessions before Christmas on those very topics. But we've run out of time for now. We've completely blown out on time. Sorry, running late as ever. Bad habit of mine. But thank you very much to all of you as panelists. Thank you for all the attendees that have joined us today as well. Next week, we go back to something a little more technical, and I'm actually very excited to have the VP of Product, Shaylee Singh, joining us from TechNab to talk us through the next evolution of what open measurement looks like. And through the OMSDK, you'll be able to measure action signals, not just in-app, but across Web 2 and tying that together. It's been a big release. It's been pending for a while, so we're excited to have access to Shaylee directly on that one. We've had a few of his team come in on a few previous webinars, but Shaylee's the guy that actually runs the whole product team globally. So I'm really looking forward to that with a local panel. So that's next week, and you should have the link there. But for now, thank you so much to you all for your time. Thanks again, panelists. That was great stuff, and have a fantastic Thursday.